Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham, and today is Wednesday, March 25th, and I thought I'd reach out to you with a brief market update. It's certainly been a turbulent time over the past couple of days. On Monday, we recorded a 30% drop in total from year to date for most of the major indices after the sell-off on Monday. That is the most rapid, that occurred over a 30-day period, which is the most rapid decline in the major indices that we've ever seen. So it speaks a little bit to the magnitude of the scale. It normally takes anywhere from 4 to 5 months for a bear market to reach these types of levels, or to reach the types of levels that it reached on Monday. We got there in 30 days, which just speaks to the volatility and the violence of the sell-off. Then we followed that yesterday with about a 9.4% gain on the S&P 500 and over an 11% gain for the Dow. That was notable from a historical standpoint because it was the largest single day gain that the Dow has ever seen since the 1930s, which really brings back which really brings back top of mind exactly how volatile the markets are and what's going on. And I'm also going to use that to touch a little bit on market timing, which we'll talk about a little bit towards the end. Why the gains yesterday and why the sort of 3% gain in the market today that's brought us back to that sort of 2,500 level that we've been talking about recently for the S&P 500? Well, it's all stimulus related. We have the federal government doing two different things. One is stimulus monetary policy by the Fed, and one is fiscal policy by the government. On the fiscal policy side, it looks like we have about $2 trillion of stimulus that will be approved by Congress, knock on wood, which amounts to about 10% of our annual GDP. And this stimulus is really easy to understand. These are direct payments, loans, guarantees made to companies that have been struggling with the crisis, to encourage them to continue operations, to encourage them to continue to keep people on payroll. It's literally just putting money into people's hands to reimburse them for some of the damage that the virus has created. The monetary stimulus tends to be a little bit more complicated. When the Fed announces that they're going to buy assets or buy bonds or do anything else like that, a lot of clients will frequently come to me and say, why is that exactly stimulating the economy? And I think it's important to note that, large financial institutions, be they banks, insurance companies, pension companies, anybody that has, a large balance sheet of assets, use these types of corporate bonds that the Fed is out there buying, these types of corporate assets, as their savings account, right? This is where they stick the money that they use to save for potential liabilities that are down the road. And so whenever those markets stop functioning because there's some type of buyer strike or people get scared, it starts to damage those institutions' ability to actually move cash in and out of the system in the way that they normally would. And that can get dangerous because these institutions are very large institutions. So the Fed normally steps in to provide liquidity in these types of markets to make sure that these larger financial institutions can continue to move money in and out of their balance sheet, which is important to the overall health and function of the economy. So the Fed's doing that, which is wonderful. It's always important to keep in mind that it's never leverage that creates problems for companies. It's always cash flow. And with the Fed stepping in to make sure that the cash markets, if you will, be they actual cash or fixed income markets functioning effectively, that kind of helps to smooth the wheels and make sure that we don't get companies that get caught offside on a cash flow issue that otherwise would be perfectly fine. So anyway, that's a little bit on how all of that stimulus works. We will continue to watch the administration's language around whether or not on the economic cost of the response to the virus. I think there continues to be an evolving debate there in terms of when the U.S. economy should get back up and running. And that's obviously a pull and push between both healthcare officials on one side and some of the more conservative economists that are out there on the other. And I don't think we have a true resolution to it yet. In the meantime, as you think about your own portfolio, I think the move yesterday is something to keep in mind when you start to think about trying to time markets. And I know that it's scary right now. These are your accounts. You've watched them drop anywhere from 15 to 25%, depending on your overall allocation, and maybe more. But days like yesterday emphasize the importance of trying to not time the market. If you got out at the wrong time and you missed yesterday's rally, that's a 9.5% return that you may not get another bite at the apple on. So please, if whatever allocation that you came into this market with, you can make rotations. You might decide to shift your asset mix a little bit. But it's usually a good idea when times get this volatile to stick with the allocation that you came into it with and not make massive changes. If you need to make massive changes in your portfolio, you need to wait until the market calms down a little bit more so that the bite doesn't feel as bad on the other end. As always, if you have any questions, please feel free to reach out to me or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.